time in the market, not timing the market.
Welcome back to the 5th episode of the Potato Finance Podcast. I am here with my friend Blake Moore. Blake, how are we doing today?
Josh, we're doing pretty good today. What's going on?
Same old, man. I was actually really excited to have you on because you're one of the few people that I kind of bounce stock ideas off of, because I always talk about how important it is to really, I guess, surround yourself with like-minded people and really have people around you with the same mindset. And you're someone I trust their opinion. I bounce a lot of ideas off of you. You bounce a lot of ideas off of me. We're going to get a lot into that in this video, but I really am excited because I feel like this is going to be the first episode where we're going to deep dive a little bit into stocks. We're going to kind of touch upon some different things that we haven't touched upon yet. I'm just really happy to get into it. So let's open it up. We'll give you the floor here. So why don't you tell everyone about yourself? Maybe your investing journey, how you got into the market. You have the floor.
Well, start off. Thanks for having me, Josh. I've been looking forward to this as well. Like you said, I feel like probably a little more than a year and a half. We've been going back and forth, bouncing different ideas off of each other, talking about stocks, this and that, different strategies, things of that nature. So to start off my investing journey per se, I would say I started in, I remember exactly, December of 2017. I had been working as a college student and a high school student, so I'd been working a lot of hours. I felt as though I had, a decent amount of money saved up for a college student. Obviously I feel like almost for anyone, when I first started working, you get that part-time paycheck and you go out and you spend it all right away.
Right.
So it wasn't until probably about, I'd say, a year into working where I was like, okay, like I need to save some money. And I almost got obsessed with it. I was like, okay, like I want to build that savings account, get it to a bigger number each week. I'm working, as a college student, I'm working minimum, maybe a little bit more than minimum wage job. I forget exactly what I was making at the time. But yeah, each week, I wanted to save 60, then I wanted to get 80, I wanted to, put a little more in each week. And that kind of got me thinking, like I said, like I kind of just mentioned, it was December of 2017. I kind of had a decent amount built up. I don't remember the exact number off the top of my head right now. But I had enough in my savings account where I said, okay, I can risk or gamble this amount into the stock market. At the time, I wasn't, who is when they first get started. I didn't know much about the market, but I wanted to learn, and I felt as though I had a decent amount built up that, I could if these stocks that I bought hit $0, I could still survive. I was still in a position to, live my life.
Right.
If these stocks that I so-called gambled on went to zero. I didn't start off with a lot. I think my first dump into my brokerage account might have been $500. So I wasn't working with much, but
You got to start small. I think that's important to start small, because I feel like, say you had like 10 grand, you got to throw in all 10 grand in there all at once. You would have been freaking out. Like the volatility would have gotten too much to you. You probably would have ended up panic selling. It would have been a disaster. And I know the feeling.
Exactly. So, so I remember I had bought one share VTI at the time, and I had bought two. I was doing some random lookups online. What stocks are going to make me rich? Looking on Google.
Right.
And I had bought 2 shares of Micron. And I had bought 2 shares of a company named Criteo, ticker CRTO.
What is that company? I've never even heard of it.
It's kind of like an ad. They do advertisements, kind of like a Facebook-ish like sell-off kind of. It's a small cap, and I'm thinking, okay, I got some shares of this. Like this could really make a run.
Like under $1 billion market cap?
I don't remember off the top of my head. I think maybe 4 to 5 billion, if I'm guessing.
Relatively small.
Yeah, pretty small. So I had 3 holdings, and I split them up. I had about $500. Nothing, literally pennies,
Yeah, right.
But it was December, and I said, okay, tax man's coming soon. I'm going to get my tax return. And I remember just looking so forward to getting my tax return. I couldn't wait to make another dump in, because I wasn't quite at the point where I was confident enough to go back into the savings account and dump more in.
Right.
But I was just like, okay, I'm getting this tax return. And here we go. That's kind of how I started off. The reason I kind of wanted to get into it is I had read an article online basically stating what I feel like is obvious, but it definitely probably isn't obvious to everyone, that the S&P 500, for the past whatever it is 100 years, average return roughly 10%. And I'm thinking to myself, damn, I have X amount saved up. If I can get 9 or 10% of that, I'm going to be rolling, I'm going to be feeling good. Hell, even if that's wrong, even if say it's 7%, hey, I will take that.
Right.
So that's kind of one reason I got into it. The second is I was talking to a friend's father, just about dividend investing, which really interests me. I'll kind of get into that a little bit more as we go. But so basically, I can own shares of a company. These people are way smarter than me. But just because I own shares of that company, you're going to pay me every month or every quarter?
It's an interesting concept. You're basically getting paid to hold the stock, essentially.
Sign me up. So that kind of interested me as well. I have another story about that we can kind of get into as one of my next kind of purchases. It's kind of looking back that I a little bit regretted, but I feel like everyone, has something like that. So yeah, that's kind of how I got started. And that 2017, that was 4 years ago, and yeah, so it's been a good journey.
It's interesting because I feel like, and I talked about this in I think a recent video, but I took a similar path in regards to, I felt like I had a decent amount of money saved up, and it was just like, I don't know, putting money in a savings account wasn't exactly going to get me to retirement. So I started dabbling a little bit. I did the opposite of what you did. I put way too much money in at first, and it wasn't the best feeling seeing all that volatility.
Interesting.
I know we talk about how often we check our portfolio, and I was checking mine like 10 times an hour. It was just like insane. It's something I really don't miss. It's something I understand much better now, obviously. Something I don't ever want to go back to again, and obviously now I really want to help people as much as possible, really take control of their financial future. But what exactly interests you about dividend investing, would you say? Because I like the concept of it. It's really cool, like I said before, to kind of be able to hold stocks and get paid to hold those stocks, because even if the stock price goes up or if it goes down, granted, maybe if you're in a once in 100-year health event, you might not receive that dividend. But really, all in all, you get paid to hold those stocks. But I think it's a little bit difficult, and I don't think it's the best way for newer investors to get into, because if you have, say, $80 billion like Warren Buffett does, you might as well just buy dividend stocks, because you're going to get paid out like insane amounts of money.
Exactly.
But if someone watching this podcast or watching this video, might not be the best idea, at least I feel like, because you're not going to see as great returns as you could see by going down the route of looking at stock price appreciation.
Oh, and I think, you raise a great point there. I think it's good to have, a little bit of each to maybe start before you say, okay, I am just going to have a dividend reinvestment, portfolio. I'm just going to go straight dividends. Right. I think it's nice to maybe have a little bit of each. But what really interests me about it is kind of like what you were saying. They pay you monthly, quarterly, whatever it might be. But you're getting that payment. Whereas, okay, maybe you're just getting into investing and you're not that confident in your picks. Now, you kind of, you're going to get at least something. Say you buy a stock and it dips, 3-4%. You can definitely buy more shares and then you'll gain more dividends. But at least now you kind of know you're not sunk, if that makes sense. At least you're getting some form of appreciation on your money. Because, especially just getting into investing, you might buy, a stock that just quite frankly doesn't pan out. But if it was a dividend stock that didn't pan out and you lost, your share price went down, at least you had those dividends to fall back on. That's kind of how I think about it, because not everyone, it really takes patience, and not everyone is capable of being in it for the long run. I mean, most stocks, I look into different stocks weekly, and over time I've owned different stocks and just sold them and made a little bit of money. Maybe I remember, I think 2019, like fall of 2019, I had Zillow, and I think I was maybe in at like 40 or 30 or 40 or 50 a share, whatever it was. And I look today and it's at 70. And here I am thinking I'm the man at the time because I sold it and I maybe made, 5%. I'm like, oh, that's great. Okay, Blake, if you would have held on to that, now you'd be doing a lot better. But it could definitely swing the opposite way. You could lose money. Your share price could go down after you buy that stock. Maybe you didn't do such great research, or maybe some bad news came out about a company and it just didn't pan out for you. But I like the fact that you at least have that safety net of, collecting a monthly, a quarterly payment.
Yeah, that's a good point. I feel like I like, especially for newer investors, I like the GVD method, growth, value, dividends. And I feel like growth should actually be, I think it should actually be VDG. I think growth should actually come last in that because I feel like growth stocks are the hardest to value. Because you might see a PE ratio of like 250 or something ridiculous like that. And it's going to be extremely hard to value that company because
Definitely.
if you look at the metrics, it's insanely overvalued. But on a long-term basis, is it really overvalued or is it just like not really hit its stride yet? So I really think for newer investors, I think value investing, like, the Walmarts, the Walgreens, CVS, stocks like that, those stocks aren't going to 3x, 4x over the next 5 years. They're just not. Like, the market caps are too high.
Exactly.
Apple's not going to go, to an $8 trillion market cap over the next year. It's just not going to do it.
It might.
It's
No.
not going to do it. There's literally a 0% chance of that happening. But at the same time, I do agree with what you say. There's less volatility in those stocks. Like, at the same time, Apple's not going to go from like a $2 trillion market cap or whatever it is to say 8 or 10 trillion. But at the same time, is that market cap going to go to like 100 billion? No, that's very unrealistic.
Exactly.
It's a very safe investment. And we've talked about this before. Although you're not going to make insane, I guess, percentage gains, you're not going to make insane amounts of money in stocks like Apple. At the same time, you're not going to lose insane amounts of money. It's going to get you used to the volatility. It's really just going to get your feet wet in the market. And as Warren Buffett says, you don't test the river with both feet. You got to stick one foot in first and see how deep it is, and then you can start diving in. But let's kind of move off that a little bit. I know you said you like dividend investing, but how do you feel, or how do you invest? Do you invest mainly in individual stocks? Do you invest in index funds or ETFs, as we talked about? What exactly do you go? Do you have a mixed portfolio? What's your philosophy?
Yeah. So right now I have 8 holdings. I have 3 ETFs and then 5 kind of individual holdings. My first and third biggest holdings are VTI and VYM, respectively. VTI just kind of gives you almost a mirror image of the S&P 500, which I think, in my personal opinion, I think almost everyone's maybe greatest holding or X percentage, like highest percentage of dollar amount should be in the S&P 500, just because it's hard to beat that. You can do all the research you want, and yeah, some people are great at it, but overall, like, it's almost, I keep saying, the safety net. It's almost nice to have that safety net that you're getting that 9, 10, 11% a year. So that's, I kind of like that. VYM holds, I forget the exact amount, but that, back to the dividend investing, they hold all dividend companies, and they pay you, I believe I forget the exact percentage, but they pay a decent dividend each quarter. So I like them. And then actually my smallest holding right now is another ETF, and that's ARK, Kathy Wood. You're familiar with it?
I am familiar with it. I am.
And I just mainly wanted to get some exposure to Tesla without buying just Tesla. So that's got a lot of, I believe it's like around 50 or 55 tech companies, and it's got Tesla. So kind of mirroring that for the most part, I believe. I think like 11% of the fund is Tesla.
That's interesting. I've never actually thought of ARK Invest like that, but that is an interesting concept. I've thought about doing something similar with Coinbase, for example, as I've talked about before. I'm not huge into crypto. I still have some concerns about crypto, but I do like crypto. So I've thought about buying Coinbase as more of an indirect crypto play.
Kind of get that exposure.
Right, exactly. But why VTI over VU? Because I know what you're saying. I feel like, and this is kind of going off topic a little bit, I know I just asked you that question, but I think it is important that everyone does hold some sort of S&P 500 fund as a safety net. Obviously, if you're like some sort of full-time investor, maybe it's a little bit different, but I think for most people, you should at least hold a certain percentage of like VU, VTI, some sort of total stock market index fund in your portfolio, because it just gives you that safety net, and it allows at least me to think at the end of the day, if I'm wrong, I still have something that's going to make me money over the long term. But anyway, back to the original question. Why VTI over VU exactly?
Yeah, so honestly, to be completely honest with you, the reason I got into VTI was when I first started investing, as I had mentioned, when I first dumped in that big $500. VTI was just cheaper. And from what I had read, like, it was almost mirror image, maybe just
Right.
like a little bit different. And college me was thinking, okay, I can get more shares of VTI, not knowing that it was kind of a more percentage-based thing, the stock
Right.
market. So, and I was just like, okay, I'm going to roll with VTI, and that's where my money went. I mean, it could have very well been VU, same thing. But yeah, that I don't really have a great reason.
That's interesting, and you didn't make this mistake, obviously, for something I'm going to talk about in a second, but I think this is a very common mistake that newer investors make, that they look at the stock price of a certain stock. And obviously there's no real market caps with, S&P 500 funds like VU and VTI, but I feel like a lot of people will look at, like, say, Apple compared to Facebook, for example, and they're going to be like, oh, Apple's cheaper, I'll just buy that. But in all reality, it's the market cap you want to focus on. And that's the problem, because although Apple appears cheaper at face value, in all reality, Facebook's cheaper. And I personally think Facebook, as you guys know, is a much, much better deal today than Apple.
And that is something, when I first started investing, that I had no idea about, but have since learned.
Most people don't, but as long as you're willing to, like, adapt. And I did the same thing. Like, you'll just learn this over time. You'll learn, like, what to look for in different stocks. And me, I feel like as I continue to put in the work, I actually think it's easier and easier to invest in individual companies. I feel like it's easier to know what to look for. But at the end of the day, it just takes a lot of work. Exactly. Like, it takes a lot of research. You got to read hundreds and hundreds and hundreds of pages. Like, if you want to be like Warren Buffett, you need to read like 8 hours a day. Like, you're basically working a full-time job, like reading, which most people aren't going to do. That's the bottom line. And
most people aren't cut out, right?
Right. And I don't blame them, because that is a lot of work. It's a lot of reading. It's a lot of mental work. It's just insane at the end of the day. There's really no other way to summarize it.
Yeah. Oh, I think you make a great point. And kind of like you said, I feel like you could ask 10 people and everybody would have a slightly different story of how they might have mismanaged their money at first when they were investing. But as long as you learn from it, from those early stages, then you're all set. That's
the thing. And I said this before, and I think the reason people get away from investing so much is because they don't understand that a lot of times in the market, if you want to make money, you need to lose money first. Yeah. Because
definitely.
I said this on the last podcast, like, when you first get into investing, people think they're going to be like Steph Curry shooting 35 footers. Like, if you first pick up a basketball, you're never going to go out to where Steph Curry hits some of those threes from and just start pulling up from there. You're just not going to do it. Like, chances are you're going to go right to the front of the rim, and you're probably going to hit the rim, from 2 feet. It's just, like, insane. It's like with anything, the more work you put in, the better you're going to get it, and the more you're going to get out of it at the end of the day.
Oh, 100%. That was me, sitting in my bedroom. I'm looking, okay, what stocks are going to make me rich when I'm a junior in college? How can I throw a Hail Mary, and that's, everybody wants to get rich quick, but nobody wants to put in the effort to actually sit back, read the articles, read reports, listen to conference calls, and actually put in time and realize that not every stock is a 10x, 20x, 100x stock,
Right. And I think the main problem is when people first get into the market, they don't have a ton of money, which makes sense because you usually go to the market to make money.
Exactly.
And so you might find someone, maybe it's on YouTube, maybe it's somewhere else, I don't know, Reddit, Wall Street Bets. You see some people making, millions of dollars, hundreds of thousands of dollars. You might be sitting there with $5,000. You might be sitting there with a couple $100 to your name. So maybe you put $100, maybe you put $1,000 into your portfolio, and you see, I don't know, a $10 return. You see a $100 return. And people are like, this is stupid. This is a ripoff. This isn't real. But the thing is, and if I had to give a newer investor one piece of advice, I would say focus, and I was talking about this with one of my friends the other day, focus on the percentage gain. Don't focus on the dollar amount, because some people might make $1,000, right? But that might be like a 1% return. And then some people might make $100, and that could be 100% return. But I can guarantee you, if you can duplicate, say, like a 20 or 30% return over the course of so many years, you're going to be making a lot more than $100. I can absolutely guarantee that.
It's funny you mentioned that. I was actually talking with someone this week, and they sent me a picture of their portfolio and their percentage gain, and they said, I beat the market today. I beat the S&P 500.
Like just today, like for a day?
Yeah, for a day. I beat the market today. And that percentage gain was more than what I had gained in that current day, but my dollar amount, was bigger than that. So it percentage is everything,
That's so funny. How come, was he just like, is he a newer, like, to the market? Was he just happy he was like able to outperform the S&P for a day?
I think so. I don't exactly know, but I think he was more, I beat the market, if I can do this every day, I'll be better than the VTI and the VUs,
The thing is, it's not that easy, because like some days, like when you outperform the market, a lot of days you're outperforming the market, but when you underperform the market,
you're getting killed.
Yeah, you're getting killed, which is fine. But this is why, also going back to the S&P 500, I think it's better for new investors, focus on value stocks, to focus on maybe index fund investing, because the volatility is not going to be as great. You're not going to see a 10% downward movement in a day. Like, you're just not, like what we saw last March, you're not going to see very often. That's like insane. I think
hopefully never again.
Right? I think it was like something like the market dropped, I don't know what it was, like maybe 35% or something insane. That could be wrong. I don't know off the top of my head, but in 22 trading days, I think, absolutely insane, crazy volatility. And then the thing like responded within like 60, 70 trading days. Again, don't know if that's right off the top of my head. No idea. Strictly a guess. But it was some insane number. And I hope that doesn't scare people off over the long term.
Yeah, I mean, but then you look at it and it's like, if it does scare you, I don't totally know why, because if you lost 35%, but then if you paid attention into that, 70-day window you were just talking about, and then you gained, I forget what the percentage is, but that's great. You ended up making money.
It's easy to look at it in hindsight, though. It's very easy.
100%.
If we look at everything in hindsight, I think everyone would have put every single dollar into Dogecoin 5 years ago and would have just ridden it up, and everyone would be a millionaire by now.
Why didn't you tell me? I could have gone in.
I know, right? But that's why hindsight's such a beautiful thing. But while we're on the subject of the market here, let's kind of switch gears a little bit. How do you feel about the current state of the market?
It's interesting because I definitely feel like it's overvalued in a sense, but I'm 25 years old, so I really don't care. I have 30 or 40 years until it really matters for the price of like the S&P 500, the Dow. I think you were just saying, if you were to give advice to a new investor, my first and maybe only piece of advice would be, it's time in the market, not timing the market. Because I think, like I had mentioned quickly before, like I had sold like a couple trades over the past 12 months where I've made, a couple $100, and at the time I'm feeling great. But now I look, I don't know why I do this to myself, but now I look and I'm like, I would have made, 2 times that, 3 times that if I would have held. At the time I was feeling great, but now I'm like, what the heck, So I definitely feel like it's overvalued, but I also feel like it's interesting in the sense that I feel like, maybe you could say this every year, but I feel like there are more people investing now than ever before, just because of all these like crazy stocks, GameStop, AMC, Dogecoin, like all these different, and I feel like people are maybe starting to get a little bit more into it than they were maybe like 18 months ago. What do you think about that?
So I feel like there's more people in the market, but not for the right reasons. I feel like people, and I don't even want to call it investing, and I'll talk about that in a second, but I feel like I see so many people just trying to, oh my God, this guy made $3 million off Dogecoin. This guy made $10 million off AMC. This guy made $25 million twice on GameStop. Like, I feel like people are just trying to
hit a home run,
like
hit a grand slam.
Yeah, they just want to hit everything out of the park, like from the back, and that's not the way to go about it, because I can promise you, for every Dogecoin millionaire, for every AMC millionaire, everyone that made millions and millions off of GameStop,
there are losers.
There are some guys that took some big, big, big losses. I can absolutely promise you that. But I also think over the last year, we've seen more people into the market because sports were shut down. There wasn't a lot going on, but the stock market's open. I mean, Wall Street's working from home, which is still mind-boggling to even fathom that really happened for a period of time.
100%.
But Wall Street's still there. The market's still open 5 days a week. Let me go put some money into that. On top of that, there was some excessive stimulus that was lying around, and it's like I can't really go to restaurants, or I can't stay at a restaurant as long as I'd like. Yeah. I can't bet on sports because there's nothing going on.
I can't go to the Red Sox.
Can't go to the Red Sox. Can't go to a game. Might as well throw the money into the market. And I feel like that's why we've seen more people get into the market. But I wouldn't call it investing, because one of my friends, right? I went out to eat with him the other day, and we were talking. He asked me earlier in that day, he was asking me about Robinhood. And he's like, I don't want to use Robinhood. What's a good platform I should use? And I told him, go use Fidelity. I use Fidelity. I love Fidelity. I have no complaints about Fidelity. Go try out Fidelity and see how you like it. So he said he did it. He downloaded it. He said it didn't get really great reviews, but he said that was because he had a Droid. So maybe it's because the Droid app's not overly, I guess, well put together. No idea. I don't have a Droid, so I have no idea. I can't comment on that.
That's interesting.
That's besides the point.
I've only heard good things about Fidelity too, so that's interesting.
But I asked him, did you buy anything? He's like, yes, I bought my first stock. I'm like, oh, what'd you buy? He's like, I bought 2 shares of AMC. No.
So that's what I mean. Like, now, if he had been like, I researched AMC, I read the 10K, I read the 10Q, I listened to the conference
This
call.
is looking good.
Yeah, he like broke down the fundamentals. He justified the valuation, which I would have been completely like mind blown if he had been able to justify that valuation somehow. Okay, do I agree? No, but at least you have a bullish thesis behind it. That's investing when you can really break things down for me like that. When you're like, I got off of Robinhood and I put my money into AMC. That is not investing. That is gambling.
You may as well go over to Twin River and maybe throw it on black or
Right.
red, you know?
And it doesn't matter if it's AMC. It could be a stock like Facebook, which I'm very bullish on, which I still feel like is one of the better deals in the market. It could be Apple, even though, like I just said, it's very hard to lose money. At least I think in Apple over the next 5 or 10 years. Or Amazon, a stock that I think is going to at least double over the next 5 or 10 years. It could be any stock, but if you don't have a bullish thesis around it and you're just throwing money around, you're gambling at the end of the day.
It's almost not worth it.
Yeah.
It's tough, you know?
Like, if you're not willing to put in the work, put your money in an index fund. That's the bottom line, I feel like.
That's the easy approach. And quite honestly, it can be that easy. You know, you don't have to do the work. You don't have to do the research. You can just hop on to, there are many, maybe you like small caps, but you don't want to do the research. There are Vanguard small cap funds, maybe you want to get into mid caps.
Like, there's going to be a day in my life I don't want to pick individual stocks anymore. I'm not going to want to put in the work. I know that. Maybe it's because, or not as much. I'll definitely scale back, and I'll probably end up putting more money in index funds within the next maybe 10 years or so. Maybe I'll have a family. Maybe I'll just have other obligations. There's going to come a point where I'm just not going to want to do it. I understand that. I'll
be interested to see when that day comes, but
I think it will come eventually. I don't know when. It's not anytime soon. It's not on my radar, but I also know when it's going to be time. I will know. I'll know I'm not going to want to put in the work. I'll be able to feel myself not looking into as many companies. I'll be able to feel myself not keeping up to date with these companies and the news. I will know. I won't have that fire. I won't get as excited about it. And when that day comes, I'll be honest with myself, and I'll probably keep what I have, stay up to date with the companies I have, and the rest of the money I'll just park in an index fund.
Yeah, I mean, and it's not like you're doing a disservice to yourself. You would be doing a disservice to yourself if you were just going in and buying the 2 shares of AMC without doing any research.
Exactly. Now, I feel like the current market we're in, I feel like if you look at it from like the standard PE ratio, it's overvalued. But I don't like to look at the standard PE ratio. I prefer to look at the forward PE because I don't care where companies are being valued currently. I care about where companies are being valued over in the future, over the next 12 months. I think the trailing PE is, I don't want to say it's useless, but it's something I don't really pay too much attention to because I don't care what you did for numbers last year. I might care what you did last year during a once in a 100-year health event to see how good that management team is. Yeah. But I don't care what happened last year. Like, if you're, like, say, in the travel industry, does it really matter what you did in March and April when the whole world was shut down?
Yeah,
I mean, not really, because that's not something, maybe from a balance sheet perspective, but strictly a numbers perspective, I don't really think it's that important personally.
Yeah, I got to be honest. That's something the trailing, that's something I never really try to get into.
But I feel like, anyway, what I was saying, I feel like small caps are the deal right now. I think sometimes I look at Yardini Research. I know a couple of YouTubers look at this, and I tend to poke my head in there. I try to do it at least once a month to kind of just stay up to date with the market, see where current valuations are at compared to the stocks I own. And I feel like small caps are actually a really good deal right now. I think I looked and the forward PE was around maybe 18, which is very, very fair in my opinion. A lot of these small caps I feel like are very valued right now. And I think by the end of the summer, we're going to see a very big rotation of money. I think you're going to see a lot of stocks come out of those maybe like
growth stocks and kind of.
I feel like they're going to go into those growth stocks. Yeah. I feel like a lot of those large caps, a lot of those mid caps, and they weren't that overvalued, but they were more overvalued. And I feel like that's kind of the deal right now, like the turnaround plays, the Deltas, the Southwests, the MGM, like stocks like that have really been pushed up. I feel like you're going to see a rotation of money out of them, and small caps are going to start to push up towards like maybe the end of summer, fall time.
Yeah, no, I mean, that's definitely interesting. And even just me, myself, I've been trying to push some of the more travel plays recently just because I feel like, there are some decent deals out there. And so that's kind of, I agree. That's kind of what I've been going towards as well.
Like what? Like the MGM play like we were talking about earlier?
Yeah. So I just feel like, with everything kind of opening back up, people wanting to get out, like you mentioned before, people have some excess, money, extra stimulus money. I feel like travel is definitely going to boom,
I agree. The thing is, the only thing and I can't comment on MGM because I haven't looked into the company in depth, but the only thing that concerns me about those companies is the balance sheet.
Yeah.
Now, obviously, with like MGM, you can have a little bit more debt because, like I've talked about in other videos I've made, it costs money to put up those buildings. So you're naturally going to have more debt. It costs money to, have planes.
God,
Those travel stocks like that, it's just going to cost money. But when you have like a lot of debt and you really have not been able to, I don't want to say not been able to recover, but when you've really been in the doghouse for a while, it's something that I really have to sit down and I really have to look at and say, is this risk worth the reward? That type of thing.
It's like anything else. Everything, for the most part, everything has some risk and hopefully some good reward.
Right. But now that we talked about MGM a little bit, and that's one of the stocks that you've been investing in, what are some of your favorite plays? Maybe some of your biggest holdings, stocks that you've been buying recently. What do you have?
Yeah, definitely. So I think I had mentioned I had the ETFs. Kind of, I don't want to say against what you were saying, but my biggest individual is Apple. I feel like if I could just own one individual stock for the rest of my life, it would be Apple. One thing that I kind of like to do, and I mean, granted, this doesn't mean much, but I feel like it does make sense when I kind of like look into even think about researching a stock is, okay, do I see this product, this service being used for the next 30 plus years? And all of the stocks I own, I can say that. I have Apple, Starbucks, Airbnb, MGM. People, you're addicted to your phone. I know you are. Everyone uses it. Everyone's on their phone all the time, no matter where you go, no matter what you're doing. Starbucks. I personally don't drink coffee. Do you drink coffee, Josh?
I do drink a lot of coffee.
Okay, all right.
Not Starbucks though.
Yeah, too expensive.
Yeah, that's the thing. Like, you can make coffee here for next to nothing. Like
exactly. But when I drive by that line in the morning on my way to work,
human
10 cars deep.
Human
10 cars deep. People are addicted to coffee. I like that, so I'll invest in the stock. Travel. I've recently just got into maybe not recently, but I've had Airbnb for a little bit. People love to travel. You talk to people, oh, where are you going? What are you doing? Everyone wants to keep up with the Joneses and, go on Instagram and post the pictures at the beach and do this and that. So, yeah, I mean, obviously that's just the start of where my head gets turning. You got to do a little research as well. But, yeah, another play that I've been into recently, and I know we've talked about this one a lot. I believe you had a video on it as well. Actually, no, I know you did. Fubo. Fubo, for those of you who don't know, is a streaming service that focuses on sports, NBA, NFL, MLB, and I believe they have international soccer. So think kind of like a Netflix, right? For more geared towards sports.
Well, first off, let's go back to the first thing you said. If I had to own one stock, I don't think I'd own Apple, to be honest with you.
Oh, no, I knew.
If I had to own one, just because. I don't know. I feel like there's just better opportunities. And if I had to own one stock, like you said, Josh, you're going into a coma tomorrow. You're not going to wake up for 20 years. You can't keep your money in a savings account. Where do you want to park it? It'd honestly either be Facebook or it would be Amazon. It'd be one of those two. And I'm actually going to say Facebook because I own Facebook. I don't own Amazon. But I think it would be Facebook. And it would be Amazon because Amazon just has so much growth ahead of it. It's like, look at where Amazon was a few years ago. Like, Amazon went from like, all right, you'll get it in a week to now they're at 1 day shipping.
Literally 2 days.
Like, is it unrealistic to think maybe in the next few years, maybe the next 5 or 10 years, you're going to have like 2 or 3 hour shipping, maybe 5 or 6 hour shipping?
Yeah, it's a good point.
Is it
possible
or possible? Yes. Realistic? Debatable. I think it's very, very possible. I think we're actually going to see that over the next few years. But hey, that's just me. Facebook. That company's been undervalued since I've been started investing. My biggest regret, well, one of my biggest regrets, is not buying more Facebook. Like, every day I'm like, why don't I buy more of this? Why is this not a bigger position in my portfolio? Like, literally every single day I contemplate buying more Facebook. Yeah, it's so ridiculously undervalued. And now that antitrust law, the judge threw that out, I think you're really going to start to see some great stock price appreciation there.
Yeah, I know you've been bullish on them for a while. I got to be honest, I don't know why I should. I haven't looked into them probably as in-depth as I should. But yeah, like I said, if I could just own one stock, it would definitely be Apple.
Fair enough.
I just feel like growth is there. I feel like they're doing some new things. Forget exactly. They have like the little key that like shows you where your phone is if you like lost it or something. And it's just like, whenever I was out to eat with a friend last week, I know this is a small percentage of maybe it is, maybe it's a larger percentage, but he was like, oh, like what phone do you have? I don't know, I have an older iPhone. He's like, oh yeah, dude, like I just got the new one, like iPhone 11. I'm like, or I don't know, I think they're on iPhone 12 now. I was like, dude, didn't you just get a phone like last year? He's like, oh yeah, but dude, I want the best one.
That's the thing.
So I just feel like so many people have that mindset that, I don't know, for me personally, that's kind of my play.
It's essentially a needs-based business at the end of the day, because you can tell people if you put $1,000 in Apple, you'll double up, triple up your money in 20, 30 years, whatever the case may be. And they're going to ignore that.
Yeah, oh, definitely.
But if you tell people, oh, a new iPhone came out, throw every single dollar you have at it, rack up the credit card, whatever, just put every single penny into it.
Whatever they got to do to get it.
Yeah, exactly. But anyway, going back to the Fubo, I never know how to pronounce this. Like, literally, when I made that video, I probably practiced pronouncing it at least a dozen times. Like, I literally have no idea how to pronounce it.
Oh,
like,
yeah. I think it's Fubo.
I have no idea. I think it might be Fubo. I've heard it pronounced so many different ways. I listened to the conference call recently, and he said it. I can't remember. I honestly just can't get it. I don't know what it is.
Oh, wow. Okay. Hey, that's an interesting dynamic. Maybe we could leave a comment. How do you, leave a dash? How do you think it's pronounced?
Yeah, I guess leave the pronunciation down in the comments if you really want to do that much.
What do you guys think? Yeah, but so this is one stock that I've been investing heavily in the past couple months. I just feel like for a couple reasons. One, I mean, this wasn't my reason at first. They just announced this recently. They just joined the Russell Index 3000 fund, which I think is pretty cool. Another is sports. Me personally, like I love sports, and I feel like so many people, sports take up so much of their time. So much of their energy, especially with soccer. I'm not a huge soccer fan, but just worldwide, obviously soccer is the most popular sport. So, people watching the different games, the different leagues, everything like that. I just really feel like subscription services could really, kind of boom with that. But another thing is, in the fourth quarter of this year, they're set to start up a live sports betting app on there.
That I'm very interested to see.
I don't know about you, Josh, but whenever I'm out like with friends, or I don't know, maybe my friends are degenerates. Sorry guys, but whenever I'm out and about, everyone has quote unquote action. Hey, what'd you bet tonight? Hey, what do you got money on? Hey, what app for betting do you use? So I just feel like when push comes to shove, you got a bunch of guys in a room watching Fubo, and that sports betting app comes up on the side, like little platform. I just feel like that is a money-making machine right there. I know they just acquired, I should know this off the top of my head.
Victory, right?
Victory, yep. They just acquired them, and I think they're looking to add, 90 or 120-ish new employees with that. So, yeah, this is something that I'm really into. I think it's volatile. I mean, if you're just starting to invest, I would not suggest just getting in.
I agree.
Because literally almost every day this week that I've watched it, at one point it's been down 4%, and then sometimes it'll close up 1%, up a half. It's kind of a wild ride. I don't think that I wouldn't get into Fubo thinking that you're gonna like make a quick buck.
No,
but
this is a long-term hold.
But I think for a 5-year play, 5 to 10 year play, I think you could set up for some nice gains, especially if you get in on these like 4 or 5%. I think at one point today it was down like 5.5%. You get in on some of those dips. I think it's a great opportunity. I think right now, I believe the 52-week low is around $8. The high is like $62. So, and right now it's trading at around 30 a share. So it's got room to run. Obviously, it's got room to fall too. But I would be shocked if we saw 10, 12, 14 a share.
Yeah, it's a play that's interested me. It's not one I can buy, but it's one that really interests me. I really like how their subscribers have been growing. I really like the revenue growth. I feel like that's been really good. Their finances aren't that great. I feel like
that's definitely the downside.
Part of the reason. And we were talking about this last night. I kind of put this in the category between spec and growth stock. And the thing is, I'm literally split down the middle. I think if I had to pick, I put it more towards the growth stock side, but I'm very, very hesitant to do that.
I think we agreed on that, I think.
I also think the management team could just tell this story a little bit better, like the vision that he has. Because when I looked into the company fully, I always felt that I'm like, He seems like he knows what he's doing. He seems like he has head on straight.
Oh, no, he
But
definitely
I put him in
does.
the category more of like a Mark Zuckerberg or someone like that, who really has not told Wall Street, has not shown Wall Street the vision, the story. Like, he hasn't done a great job of presenting it. I feel like if he could do that, then maybe might get some more institutional investors out there. But that's just me. That deal with Victory, I really do like that. Getting that company for $37 million, that's like essentially nothing.
They paid pennies for it.
Like, that is like absolutely fantastic deal. I haven't looked into the deal fully, but at face value, that looks like a great deal. But newly public company, and it just comes down to, do you know what the market cap's at right now? I don't know off the top of my head, but
like 4.1 billion.
so I have no idea. I know the stock price is around $30.
I'd be if I had to put money on it, I think it's like 4.1, 4.2
I'll post
billion.
it on the screen. You guys will see what it's at by the time you guys are watching this, or at the time we film this. But at the end of the day, I say to myself, are there better deals out there? Like, is the risk worth the reward? And I feel like there's just other stocks out there that I feel like have less risk and more reward. Now, does this stock have some upside? Don't get me wrong. Absolutely. Because like you said, people are going to keep betting on sports, especially as it continues to get legalized over a lot of different states, and eventually it's going to be legalized nationwide. More and more people are going to bet on sports. It just makes sense. As more states legalize it, more people bet on it. And what happens when you bet on sports? I know when I used to bet on sports, sitting right there, I'm watching that game, and I'm not turning it off till it's over or until I know I'm losing my money.
Oh, exactly. And you know, more often than not, what you're doing, losing your money.
Right.
I know I do.
Right. Or if you win money, you want to bet more. And where is the best place to do that? Fubo.
When you're sitting right here, the TV's right there, and it's that easy. So, I mean, you say bet on sports. I feel like I know some people, you know, if they lined up some ants, you know, on your street outside, and they said, all right, ants run across the street, they'd bet on it. People, I just feel like they love to, you know, like you're saying with the AMC and the Dogecoin, people love to gamble. So
just get rich quick.
Exactly. It's the get rich quick method. And for me, I kind of want to sit back with the stock and hope that I can, you know, see some return. And like I said before, I don't expect it to, you know, pop off in the next couple months, but I think definitely over the next 5-ish years, I think it would definitely be a good play.
I also have a lot of concerns about the competition. So on one side, you know, cutting the cord, that's going to be big. I really think that's like the next thing. I think if you look like 10 to 15 years out, no one's going to have like Cox cable.
Maybe the cord won't exist.
Like exactly. It might not even exist. Like, I don't have cable here. I use Hulu. I don't use Fubo. But the competition, you know, YouTube TV, I think YouTube TV has the potential to be the biggest player in that field by a lot. Like, if YouTube was like its own separate company, I would be buying a lot of YouTube. Like, that's for sure. I really would. But I feel like the competition on the streaming side of things, that concerns me because it's so hard. It's so hard to separate, like really differentiate yourself from the pack here. And I know this management team has done a good job of putting out a lot of different packages, which is great. But at the same time, does it matter to me if I have YouTube TV, Hulu, Fubo? Because I'm just going to stream it somewhere anyway. So probably not.
Definitely. And I see what you're saying. But I also don't know, and this might not sound that smart for people, but I don't see some people not necessarily having 2 or 3 streaming services at a time, just depending on the person.
Interesting. I've never heard that. That's very interesting.
Yeah, I mean, I could definitely, you know, like, some people don't love watching TV shows. I personally don't watch a lot of TV shows. I don't watch a lot of movies. You can see me after work. I whatever sports game's on that night, that's what I'm watching. But some people like movies too and sports. So you could have, you know, I believe I don't have Hulu, but I believe, don't they have just like an option where you can not get like the live TV and it's just like movies and stuff? So what's stopping someone from having, you know, Hulu and Fubo, you know? So that's kind of
possible. That is an interesting point, because think about it. Some people have Stars, some people have HBO, like some people have multiple services like that. I don't know if I necessarily see that, but I think it's possible. That's a very good point. I've never thought of, to be perfectly honest.
Definitely. And like you're saying, I know, like the TV packages, you know, you can get, like you're saying, Stars, you can get HBO. And I know it is expensive, but quite honestly, I feel like, you know, most people aren't great with their money. So I really don't see why some people might not have to. So the competition, it's a good point. There definitely is competition out there, but I think you know, certain ones could mold together.
I think a lot of it is going to have to do with what happens with the sports betting side of things, because there's a lot of competition there as well. I personally think DraftKings is going to be the biggest player in that field. I really, really like DraftKings a lot. And I'm interested to see what's going to happen with that, because I think DraftKings just has so much potential. And I think that branding when you look at DraftKings branding, it's just like you watch any sporting event anywhere, DraftKings is there. You watch the Red Sox, you watch the Pats, you watch the Celtics, any team, DraftKings is there. Like that branding, I think that management team is doing such a phenomenal job because he's putting so much money into the marketing. He's not even focused on profitability yet. He's focused on growing that brand. And I think that's so smart. And Fubo's doing the same thing. But I think DraftKings has told a much better story about doing that right now than Fubo.
I think you make a great point. Like you're saying, you watch almost any any sport on TV at night, and there's whether it's an ad or even you go to a game. I think like Gillette has like a DraftKings like part of the stadium, right? Something like that.
Right. I think you're right about that, but we're just gonna have to wait and see at the end of the day because no one really knows how this is gonna play out till it plays out. But
I wish I knew.
I think we all do, but at the end of the day, it just comes down to risk versus reward. I don't think Fubo is the best place for my money right now. I think there's better deals, but hopefully you're right. I hope you're right. I hope it works out for you. I do like the stock. I do like the company. It's just I need to see more from them at the end of the day.
100%. So and that's kind of like I said, it's not my biggest holding right now. I don't think it ever will be, but I think it definitely serves a place in my portfolio. For the moment at least. Who knows? Maybe it'll.
Let's talk about the process that you went through, not just to buy Fubo, but to buy any stock. Like, talk about your research process, talk about what you go through, because when people buy individual stocks, like we've talked about before, they just buy them. They're like, oh, CNBC, Kramer, he likes Delta, he likes Southwest. Let me throw some money in that. But obviously, if you want to be a successful investor, that's not the most sustainable strategy. So what do you do before you buy a stock?
So like I kind of mentioned, I kind of like to think outside of the box and think, what are people into? What are people almost addicted to in a sense? What do people love? So that's kind of something I think about. And then, if it gets down to it, okay, let's look into it. Let's see how the numbers look. A couple things, I like to look at market cap. I don't necessarily have a certain, dollar amount of market cap that I'm looking to get into, but that's definitely like one of the first things I want to look at. Another thing is I want to see, and maybe this sounds silly because like I am a long-term investor. I'm not looking to flip stocks, in a couple of weeks. I've sold stocks after a few months, but it was just because I felt like, kind of like you mentioned, I felt okay. I made money on this stock. Okay, and right now I feel like maybe it's at what I think at the time is the peak, and then of course it goes up after, but maybe I need to park my money and it's better off somewhere else.
Sometimes it's like that because sometimes you'll see things where it's like, all right, I think this company's undervalued. Like with Callaway, that happened with me. Like I don't remember exactly when that was. Maybe it was last summer, but I said to myself, this company just bought Topgolf for half of what the valuation on Topgolf itself. They're going to keep building out more and more brands, or more and more Topgolfs, that is. Like I just felt like the company was very undervalued after that acquisition. I bought in, and then the thing shot up. Yeah. So I'm like, I'm not gonna.
I think you actually gave me that play. I think I actually made a little money off that. Yeah.
But I'm like, I'm not gonna keep buying more of the stock. I'm not gonna average up on a company like this. So I just took my short-term profit and I ran and I put the money in somewhere else.
Exactly. Yeah. So sometimes it's like that. Yeah. So something else I kind of like to look into, and this is just me personally. I don't know really if this makes sense. Maybe you can kind of give your 2 cents on it. I like to kind of look at the 52-week high and the 52-week low and see where we're at. Ideally, I'd like to be in the middle when I'm buying. I don't want to necessarily buy at the top, and I don't totally want to buy obviously at the low, but I'd like to be in the middle after doing some research, after checking out the PE ratios, things of that nature, and kind of seeing where I'm at. Do I have room to run? Has it already run up? Maybe I look into a stock. This happened to me maybe about a month ago. I actually forget which stock it was, but I don't want to buy it at its peak, Now I'll put it on my watch list and I'll see, is it going to fall? So that's another step. And then honestly, I like to read a few articles. You type, X stock, have it come up, and read. I really love, I don't know, I haven't heard of you speak of this, but I really like Seeking Alpha. And I feel like maybe some people might not think that's the best app just because it's kind of like,
I think it used to be better.
Yeah,
personally.
and he just like Joe Schmo, like writing an article. But honestly, like I've found the stuff on there to be like super helpful.
I find I go there, like that'll be one of the last places I go. Like but I mean in my research process, because I'll start off with the fundamentals of the company. I'll start going through the 10Ks, the 10Qs, like the conference calls, and I'll start to develop like my own opinions, because I feel like if you start off at Seeking Alpha, I feel like especially with a newer investor, it can be very easy to be persuaded
get
into
hooked.
whatever Johnny's writing on there. So I want to have like an idea of the company, and I really want to have a good understanding of the company. Then I want to go in there, and then I want to start picking those articles apart and be like, oh, that's a good point. I didn't know about that. Or that's wrong because of A, B, and C. So that's why I go there like last, because I feel like if you get caught up in just what other people are doing, you're eventually just going to fall into that trap.
Yeah, so see, I mean, obviously, we're young, we're not, we've been in it for a little bit, but I kind of like to think of it as, okay, let me read and see what, Johnny's saying. Then I like to listen to the conference call. See, is what he said true, or is it a lie? So I guess, kind of on the same track of what you're saying.
Right.
I guess, just 2 steps flip-flopped. But yeah, so I mean, nothing crazy, but just kind of like those kind of steps, and just kind of, listen to the conference call. Do I like, have earnings looked good? Have they not looked good? Kind of like you've mentioned before just now, and I know you've mentioned this on other shows before. Does this management team have experience? Are they new? Do they know what they're doing? Have they performed before? Kind of just things like that. I don't want to say it's like a step 1, 2, 3, 4 process, but kind of all those things kind of mesh together. Maybe that's not the best way, but hey, it's definitely somewhat worked for me thus far. I don't want to tell you I've made crazy money, but I've definitely made a decent amount doing that.
I mean, I think everyone's just going to have different methods that they go by. At the end of the day, like not everyone's going to do everything the same. I think everyone's just going to have a different research process that they consider full research. Some people that's reading the little profile blurb on Robinhood. Some people it's reading the 10Ks and 10Qs. Like, I think everyone's going to have a different process. But one advantage I think we actually do have, when you mentioned the management team, I think because of the Rona last year, and I guess even this year a little bit, I think that's really going to provide an advantage when looking into the management team, because you can look back very recently to a time of crisis, and you can say, okay, this management team was in a complete time of crisis. Like everything was going wrong because a lot of businesses were shut down.
How did they
like
perform?
Even like if you look at like Apple, you look at like maybe MGM or any stocks like that, business was basically shut down. It's a very difficult time. You can look at that and say, how did this management team react to that?
Yeah, I like you kind of said, that's like a once in a lifetime thing. So it definitely kind of, and I feel like that's kind of what we're gonna get into next when we talk about emotions. So I feel like that kind of, it's a good point.
Yeah, so speaking of emotions, I guess we can transition into that now. But how do you really deal with your emotions in the market? Because whether you've been in the market a while, whether you're a new investor, emotions are going to play some sort of factor. It's just natural as we are as humans. And obviously you're going to have days where your portfolio's up 5%, when your portfolio's down 5%. You're going to have great days, you're going to have bad days. Not every day is going to be a home run. Some days are going to be singles. Some days you're going to go 0 for 4 and strike out. But the important thing is, I feel like on those days where you're really down a lot, maybe you're down 5%, maybe down more than that, depending on how your assets are allocated, is to really just stick to your guns and really stick to what you had such high conviction on before.
Yeah, and I think you're 100% right when you say that. I can honestly say, and I give myself a little pat on the back, I can't say that I've ever panic sold stock, because like you said, I
can't say that.
I've done my reading. And I'm not, like I said to you, I'm not looking for short-term plays. If I'm in a stock, like I'm definitely looking at it for the long term for the most part, unless something comes up where I've made a decent amount of money and I want to park it somewhere else. But yeah, I want to say I deal with them pretty easily. I know I had told you this week. I check my portfolio far too often. I should not be looking at this as much as I do. But if it's a down day, if it's one of those 4 or 5% days, I will tell myself, okay, just don't look, don't do this. Just save yourself the stress, save yourself the headache, and give it a break.
I think that's smart. I think because if you do look at that, you're gonna think about selling it, or you might get some people might try to get cute with it, I can just sell this here, take this short-term loss, and then buy back in lower because it's gonna keep going down.
Yeah,
I feel like that's not really a good
back to the gambling.
Yeah, right. I just feel like that's really not a good mindset to have at all. I feel like you just gotta, at least with me, when I buy a stock, I'm just like, all right, I feel like the stock's going. I feel like the stock's going to this market cap. I'm excited to put money into that stock. And I also feel like another issue that newer investors really might have is they put too much in at first, which is what I did. Because say At first, that's what I did. But say you have like $10,000. You put $5,000 in. That's like 50% of your life savings.
Oh, you're sunk if say that 35% window comes and you're down 35%.
Right.
You're not feeling too good.
Like me personally, I've looked into a lot of different philosophies. I've seen a lot of different methods. And my favorite method, which I'm sure you guys watching this podcast know who this comes from. But my favorite method is I like to keep 10 to 30% in cash. 30% if it's more along the lines of, a market we're in right now, or maybe the deals aren't as great. 10% if it's a situation like last March where it's like I could throw a dart, like spin around 3 times, throw a dart, and it's going to be a bullseye. That's when I'd like to get down to 10%. But the thing is,
and years ago, before I really started taking this seriously, I just put too much money in at once at the end of the day. If you're 100% cash, which I know what some people are, I don't think that's the smartest decision personally, but if you are 100% cash and you decide you want to get down to not even 10% cash, if you want to get down to 50% cash, 40% cash, 30% cash, that should take you a while to build out that portfolio. Like that should take you over a year to really
build out, I feel like, because I remember like a while back, like I put like way too much in at first as opposed to like now. It's like I understood, like when I got into the market this time, like, all right, I need to take a disciplined approach. I need to put this much in, and I need to continue to buy in regularly. So that way, one, say I put all that money in, and then there's a stock market crash or whatever the case may be.
You can kind of average out.
Right, I can average out. Or two, on the other end, I can get used to the volatility because, like, say I had 30 or 40 grand and I had to put 25 or 28,000 in, I'd be like, like you checking my portfolio every 2 seconds.
Yeah, you can't be doing that.
But on the other end, like if I put like say $1,000 in, that's like, I don't even know what percentage that is, but it's a very small percentage. You know what I mean?
Yeah. Oh, 100%. I think it just depends. And like I kind of mentioned before, it's the time, with time you gain more experience, you gain more kind of traction in the sense that, okay, you had a 3% loss on the day, but it's not killing you, because long term that your plays, you've done the research.
All right, so moving on here, a little bit of a different topic here, on the market but also off the market, something that's really been talked about a lot very recently. How do you feel, and before I even ask Blake this question, this is a very neutral perspective here. We're not going left wing, we're not going right wing, we're going right down the middle, very neutral perspective because this is coming up. It's something that's going to infect every investor out there. It's going to infect you, whether you like it or not. It's going to affect you. So it's something worth talking about. And hopefully, after hearing what we have to say about it, you have a better understanding as to why. So, President Biden has proposed a capital gains tax hike. And I know there's going to be someone in the comments that's saying, oh, it's just for the rich. It's just on certain people. I understand that. But it's going to affect all of us in one way or the other, whether we have $10,000 on the market or we have $10 million on the market. How do you feel about that tax proposal?
I'm really not a fan. I really don't like it in the sense that I feel like it could, maybe someone's watching this video right now and they're thinking about getting into investing. And now I have to pay more tax? Oh, geez, that's not good. So overall, I'm not a fan. I feel like we should be doing everything to get more people into the market. I think if there's one thing that the COVID kind of taught us, it's that most people can't even go 2 weeks without a paycheck. So if you had money invested that you're liquid in, you have in your taxable brokerage account, now at least something crazy happened, you lose your job, you got to make an emergency payment, you should have money invested. Obviously it's not ideal to take money out of your positions, but it's good to be invested, and I just feel like that could kind of sway people away. Well, what do you think?
Obviously it's probably not going to affect Johnny on Robinhood because it's only up to like, I can't remember exactly off the top of my head exactly how much you have to have a capital gains tax for it really to affect you. But the thing is, the rich control the stock market, whether you like it or not, whether you like a capitalistic society, whether you're not. I can see both points. I understand both views. But the rich control the stock market. So who's going to get affected by this the most? The rich. So what's going to happen when, assuming this were to pass, which I don't think it's going to pass, which we're going to get into in a second, but assuming this passed, what's going to happen? The market's most likely going to crash. I would be very surprised if, assuming this passed, the market does not crash. Like completely 100% surprised. And I think that's going to really push newer investors away from getting into the stock market. I think they're going to be scared of the market. I don't think it's going to be the cleanest scene. I think it's going to be pretty ugly, pretty scary.
Yeah, no, and I think you're 100% correct. I think you make a good point. And, you bring up Johnny on Robinhood, who's only got $1,000 in there. But you know what Johnny's goal you would think would be? Get up into that higher tax bracket.
Right. And it's just like, exactly.
And
that's
have
what I was
that money
thinking.
Invested. Like, just because it's not affecting you now, hopefully if you're pulling the right moves, you're saving your money, you're making a lot of money that you can invest, then it's going to get you down the line,
I think more people would go towards real estate, to be honest. Like, I think you'd see a crash very fast because say this was about to pass, like say hypothetically this passed at the end of 2022. I think you'd see a very dramatic stock market crash. I think you'd see a lot of those wealthy pull money out of the stock market, and I think you'd put it into real estate because you can still 1031 it at the end of the day. Definitely. And you can just still keep rolling it over, and just keep running with it and avoiding that tax until eventually you die or you sell and end up paying those taxes on it.
Yeah, no, I think I totally agree with you. So yeah, overall, I don't love it, but hey, it's not for me to decide.
I personally think, and here's my real thoughts on it. I really think this is a negotiating tactic because is it really realistic to just double capital gains like that?
No.
Probably not. Yeah. But anyone who knows how to negotiate, it's common sense. You never say the number you want. If you go into a job and you say, I want to make $80,000, right? And they offer you $75,000. Are you going to say, all right, can you pay me $80,000? No, you're not going to do that. You're not.
No.
You're going to be like 85 or 90. You're going to highball it so they'll meet you in the middle at 80 or maybe even get more at 85. When you go to buy a car, if you want to pay $12,000 for that car, are you going to sit down at that desk and say, I want to pay $12,000? No, you're not going to do that.
Nope.
And I think Biden's camp is, I don't want to say the smart because I don't agree with it. I don't like paying higher taxes. I don't think anyone likes paying higher taxes. I don't like stock market crashes. Well, kind of, because I get better deals. But I really feel like his camp's like, let's just shoot for the moon, and they're going to meet us somewhere in the middle. Do I think it's going to go up? Yes, I do. But at the same time, I don't think it's going to be like 40%. I think you'll see like less than that. Like I think they'll meet somewhere in the middle. I really believe that.
I hope it's not double. I can definitely tell you that.
But we'll see what happens. Like I said, I guess it won't affect our profits too much per se, but it's going to affect our investments because the market is most likely going to crash if this does pass at the end of the day. That's the truth. But a couple more things before we wrap up here. We're almost done here. Thanks you guys so much for listening. You've gotten this far into the podcast, but Blake, throughout your investing career, and I experienced a moment several years ago where I really thought that maybe investing's not for me. I couldn't handle the volatility. This was back when I had lost the $1,500 I had talked about in one of my few videos. I was really stressed out about it. I just couldn't figure it out. Did you ever have a moment like this where you really thought, like, maybe investing's just not all cracked up to be? Maybe investing's just not for me. Maybe I should do something else with my money. Maybe I should just park in a savings account.
Yeah, I mean, maybe I think about this like a little bit every day when I'm like not making the right place. No, I'm just kidding. More specifically, I do have like a very concrete example of this. So I had mentioned that I was saving up I wanted to get the tax return and make another purchase. I think I had said that like first in the video. So I did that. Then I was, slowly saving up. I was only in college. I had, 2 summer jobs. I had an internship in my regular job. So now I'm saving up, and I had my eyes on AT&T. I was hunting that dividend, right? So I wanted to get into AT&T. I don't think I did the due diligence I maybe should have, but like you said before, hindsight is 20/20. I don't know. I guess I have a good memory. I think it was like October of 2019. I had bought in at like $33 a share. Little did I know that was a lot for AT&T. I think over the next 3 weeks, it dropped like 10%. I was so mad at myself. I'm like, okay, I had just saved up. Like,
what are you doing?
I had like, maybe it was $1,000. I think I bought around 30 shares. Yep. So I'm like, oh my God, like Blake, are you an idiot? Like, if you would have just waited 2 weeks, like you could have got such a better deal. And so then for the next, I feel like 3 or 4 months, now I'm trying to like dollar cost average it down. I'm like, okay, I can get it. I can get this down. That was like definitely by far and away the most frustrating portion of investing for me. I was so frustrated, and I was just like, maybe this isn't for me. That was definitely a struggle. And AT&T isn't the kind of stock that's going to go back up like quick, like it's kind of parks around that like 28 to 33 range.
Right. Now, were you able to overcome that and kind of just be like, you know what? No, this is a good idea. This is what I need to do.
I told myself, okay, like, this isn't that bad. Like, I'll collect this great I was still fairly new to this at the time. I'll collect this dividend. This will be fine. Long story short, I ended up selling out of that. I think I like maybe broke even or maybe made like $50 or $100, not like literal pennies. But I didn't sell like right after. I didn't panic sell. I think I held it for like 2 years after.
So it was like
yeah. So it was a wash for me. But you live and learn, and I'm just glad I didn't sell it after that 10%, take a 10% loss, and that I kind of worked my way back from it. I'd say that was definitely my worst experience.
I think sometimes that's just going to happen. Sometimes I think you're just going to get into a bad stock.
Yeah.
At the end of the day.
I really feel like everyone can just get into a bad stock because sometimes you're going to get a little unlucky. Like if you invested in, say, maybe an airline company, and then all of a sudden a once in a 100-year health event breaks out, that's just bad luck. Like you can't be like looking at like a chart, or you can't be looking at the fundamentals of a company and being like, this company's going to get hit by a once in a 100-year health event. It doesn't work like that. Like sometimes you're going to get unlucky. But the thing is, if you stick to your guns, you really put in the work, and you really just stick to your strategies, and you do that consistently over 20 or 30 years,
you'll be good at the end of the day.
You're going to be golden. And the last question I have for you, the last thing I really want to talk about here. Everyone watching this video, my following is mainly pertaining to newer investors, people that want to get into the market, people that want to start investing, people that want to change their financial futures. What's one piece of advice, and none of this is financial advice, by the way.
I am not a financial advisor.
If you had to give one piece of advice to someone watching this that's made it into this hour-plus portion of this podcast.
Yeah, I mean, if you've made it this long, more power to you.
You want to give people one piece of advice, how to invest, or maybe someone just who's a new investor and maybe that's struggling, or maybe someone that just wants to be better with their money. What is the one rule that you would give them?
I would say just patience. And like I had mentioned before, really, it's time in the market, not timing the market. I think, like I had mentioned, most of the stocks that I watch, even this sounds like almost criminal and like stupid, but even after I sell my stocks and like I'm out of them, I still kind of watch them just to see like maybe I missed out, maybe I was smart in my trade,
I like that because sometimes I look at it as sometimes you have to break up with the stock, but sometimes you get back together with your exes. So is it really that hard to maybe pay attention to what this company is doing for numbers? Just like Google that company once every couple of months, see if there's any big news coming out. And sometimes you might have some really great news come out, or maybe something like happens on the inside of that company. Maybe you have the change of management, and all of a sudden you're like, stock's a deal and a half right now.
Exactly. But yeah, I mean, for the most part, I just think if you do your due diligence, whatever you find, like we had said, there's a couple different ways to go about it. I don't necessarily think one way is better than the other, but if you sit back and just let your money work for you, I think at the end of the day, whatever you're, over the long haul, a month, 2 month, 1 year, even I'd say maybe like an 18-month period isn't going to be great. But if you have a 5, 10, 20-year gap, I mean, this is almost a sin. If you've done your research and you're in good companies, you'll be fine. Don't pay attention to the day-to-day. Look long-term. Keep your eyes on the prize at the end of the day.
I think that's a great piece of advice because you hear so many people like on a day-to-day basis saying, when I get a better job, I'm going to start investing. When I'm out of school, I'm going to start investing. Like, I really think it's so important to like, all right, if you want to change your financial future,
start now.
Like you say you can't afford it. Like some people, maybe you can't afford it. Maybe you're watching this podcast and you literally live paycheck to paycheck and you have kids, you have more people. But if you're someone that says you can't afford it and you're someone that's going out to dinner a couple times a week, going out for drinks a few times a week, maybe you should reevaluate your spending. That's just how I feel.
Even if you're dumping in, say you can put in 25 a week, it's better than where you were at before.
And it's going to get you used to the market. You're going to understand strategies, and you'll learn to treat every dollar with love. Because going back to the example I gave before, when I had put too much money into the market all at once, volatility was too much. But if I had started putting off maybe like $20, $30, $40, $50, I wouldn't have nearly been as nervous.
You would have been more familiar with charts. You would have been just more familiar with the flow, And yeah, and I believe, I'm not on it, I don't know if you are, but I think Robinhood does fractional shares. So there's literally no excuse. You know, if you have an extra 20, 25, 50 a week, get in by, you know, maybe you like Starbucks, but you don't have, you know, the $116 it is a share, you know, to buy, you know, but in 4 weeks you might have a share, you know?
Right. And to clarify what fractional shares are, if you guys aren't aware, say Facebook stock's $300, right? And you only have $150, but you really want to put it into Facebook. You can buy half a share of Facebook to really simplify it. I think it's a great idea. I think you're going to see less and less stock splits over time because of that, because I think stock splits are kind of stupid, to be honest, because there's really no reason to split the stock because it's all about market cap
But
at the end of the day.
But that's because
I understand.
You know about the stock market.
That's true.
Yeah, like a lot of people, you know, most people are looking at that price and saying, okay, Apple just split from, what were they at, 230, they went to 115. Okay, now I can buy more Apple. So on the surface, you're 100% correct, but
not everyone thinks that way. Not everyone understands.
Exactly.
Blake, man, anyway, this is a lot of fun. Hopefully you can come on again sometime. Thanks so much for coming on, man.
Hey, thank you so much for having me.
All of Blake's info will be linked down below in the description. Like, subscribe, comment, download, as always, guys. Thanks so much for watching. If you made it to this point in the video, please, I know I just asked you, I'm going to ask you again, drop a like on the video, and I will see you guys in the next one.